On a seemingly ordinary Tuesday in late January 2025, $1 trillion disappeared from U.S. tech market valuations. Not because earnings collapsed, not because a war started, but because capital repriced the future. When expectations shift, money moves. And when money moves, capital cycles reset. This wasn't random volatility. It was the market recalculating the cost of intelligence. A Chinese startup called DeepSeek released a paper claiming they trained a top-tier AI model for a fraction of the cost. If accurate, and that's a big if, this changes the economics of AI fundamentally. Wall Street panicked because the valuation models broke. Because valuation models are not built on headlines. They are built on cost curves and revenue projections. And Nvidia's revenue projection assumes one thing: that training frontier AI models remains capital intensive. If the cost curve bends downward faster than expected, forward earnings assumptions must compress. Even before reality changes, the spreadsheet changes. And markets trade spreadsheets. If AI training becomes dramatically cheaper, does the demand for Nvidia's expensive chips collapse? Or does something far more interesting happen? To understand the future, we have to look at the money trail. We shouldn't be asking, is this a bubble? We should be asking, who actually pays Nvidia's bills? Here is the hard data from recent SEC filings. Nvidia is a $3 trillion empire, but its revenue is terrifyingly concentrated. Bloomberg data estimates that nearly 40 to 50% of Nvidia's revenue comes from just 4 massive customers: Microsoft, Amazon, Meta, Alphabet, that's it. This is not diversification. This is dependency at scale. And dependency creates reflexivity. If hyperscalers accelerate spending, Nvidia's revenue explodes. If they pause even slightly, growth rates collapse. Because this is not consumer demand. It is capital expenditure concentration. And capital cycles are historically volatile. Concentration works beautifully until it doesn't. But remember, this risk cuts both ways. The customers are also addicted to the vendor. High margins often come with high dependency. This isn't a broad industrial revolution yet. It is a vendor-client loop with 4 rich customers. If just one of these giants decides to stop spending, Nvidia's stock doesn't just dip, it crashes. Sequoia Capital calls this the $600 billion question. To justify this capex spending, AI needs to generate $600 billion in profit. Right now, it generates a fraction of that, which means we are front-loading infrastructure before fully monetizing it. This is classic early cycle behavior. Build first, justify later. The risk is not that AI fails. The risk is that monetization lags investment, and markets punish timing mismatches. We are currently in the build-out phase. Just like in 1999, companies are overbuilding capacity because they are afraid of running out. This looks exactly like the year 2000. Let's talk about Cisco systems. In 2000, Cisco was the Nvidia of the internet. They built the plumbing. Everyone needed them. Cisco became the most valuable company on earth. People said the internet is the future, so Cisco is safe. They were right. The internet did change the world. Cisco did not go bankrupt. The internet was real. Cisco was profitable. The problem wasn't the technology. It was the price investors paid for certainty. When the bubble burst, valuations reset, and decades of returns disappeared. It took 25 years, a quarter of a century, for Cisco's stock to return to its year 2000 peak. Great company. Wrong timing. Generational wealth destroyed. Investors who bought at the peak weren't wrong about the future. They were wrong about the entry price. Technological inevitability does not equal valuation inevitability, and that distinction is everything. Are Nvidia investors walking into the same trap? Maybe. But there is a twist. A counter-theory suggests that DeepSeek didn't kill Nvidia. It might have just saved it. It is called the Jevons paradox. In 1865, economist William Jevons noticed that when steam engines became more efficient, coal use didn't drop. It skyrocketed. Efficiency lowers cost. Lower cost increases access. Access increases total demand. But Jevons' paradox only works if adoption scales faster than efficiency gains. If AI models become cheaper but capital spending slows, demand may not accelerate. So the outcome depends on one variable. Does lower cost trigger mass experimentation or capital discipline? We didn't save energy with efficient engines. We built railways, factories, empires. Because when something becomes cheap, we use it everywhere. If AI training becomes cheap, we won't stop using chips. If the cost of intelligence drops to zero, we will embed it into every device on the planet. We will put AI in everything. Your car, your fridge, your glasses, your national defense grid. We will create millions of specialized models, not just one giant model. This means more inference, and continuous inference requires continuous chips. The demand for compute won't drop. It will explode because the barrier to entry is gone. But this brings us to the biggest bottleneck of all. It's not just chips, it is energy, cooling, and grid capacity. Data centers are already consuming massive amounts of power. Estimates suggest consumption could double by 2030. Electricity is not a software problem. You cannot deploy power generation with a software update. Grid expansion requires permits, materials, political consensus, and time. Which means compute growth may eventually collide with physical infrastructure limits. We are running out of electricity to power these brains. The grid is the new constraint. AI models don't run on intelligence. They run on electricity. AI isn't constrained by ideas. It is constrained by megawatts. And this is where the story shifts from finance to geopolitics. The country that controls advanced compute controls model capability. Model capability shapes military, cyber, biotech, and economic leverage. As long as the most advanced models require the most advanced chips, Nvidia sits at the center of that power equation. Nvidia doesn't just sell chips, it sells geopolitical leverage. The US government has banned the export of Nvidia's top chips to China. Why? Because compute power is the new oil. Oil powered the 20th century. Compute may power the 21st, and when a resource becomes strategic, governments intervene. Which means Nvidia's future is no longer determined solely by earnings reports. It is influenced by policy decisions. It is the fuel for modern warfare, cyber defense, and economic dominance. Nvidia is no longer just a tech company. It is a strategic asset of the United States. In a world where nations are fighting for AI supremacy, the supplier of the fastest chips holds the keys to the kingdom. So the real war isn't about the bubble bursting, it's about a split in reality. Scenario A: the hyperscalers stop spending, margins compress, and Nvidia crashes like Cisco. Scenario B: compute becomes a national security issue, and demand becomes structurally embedded for decades. Reality rarely chooses one extreme. It compresses margins and expands usage at the same time. If you are an investor, you have to understand the cycle. As an investor, your edge is understanding which force dominates over time. Because history suggests one thing: when technology gets cheaper, the world changes. The mistake investors repeat is confusing technological inevitability with investment inevitability. The AI revolution will happen. The only question is whether today's investors are funding it or owning it. Every capital cycle feels permanent at the top. This is what capital cycles look like: breakthrough, euphoria, constraint, consolidation. And the hardest part is knowing where we are in that cycle. Let's pause and look at the bigger picture one last time. Why does this cycle repeat itself? Because human psychology never changes. We are wired to chase the new shiny thing in every era. In the 1800s, it was railroads. In the 1920s, it was the mass adoption of radio. In the 1990s, it was the internet. And now it is the dawn of artificial intelligence. The historical pattern is always the exact same: massive investment, overcapacity, and a brutal crash. But then, the real utility emerges from the ashes of the destroyed capital. The railroad boom crashed entirely, but the trains kept running and built the modern world. The dot-com bubble burst, wiping out trillions, but the internet ultimately took over the world. The AI bubble might burst in the near future, sending technology stocks crashing down hard. But the massive compute infrastructure we are building today, that is the foundation of the next century. The speculative money might vanish overnight, but the underlying technology is completely permanent. Infrastructure outlives speculation. Capital rotates. But physical systems remain. The question for investors is timing, not direction. So, take a deep breath. Look closely at your portfolio and the companies you own, and ask yourself the ultimate question: are you buying the future or just paying for the hype?